Okay, it's not saying recording in progress because it already said that for Simonetta. I forgot. So do you just want to give a quick hello and an intro?
Hello, everyone. I'm Anthony, founder and CEO at SeedLegals. I see many friendly faces who I know already on the call. And Purdy and MA asked me to go through and do a fireside chat on terms in a term sheet. So I had this genius idea. Why don't I create a sample term sheet, since I can't share anyone else's, of course, and go through the terms together. So over the next 20 to 30 minutes, we're going to have, I hope, an interesting, because I mean, going through a term sheet could be super boring, but I hope we'll keep it super interesting. A term sheet that you might receive and look at all the terms that you want to focus on, which ones you might want to push back on, which ones are outrageous, and which ones are actually quite reasonable. So, term sheets, firstly, let's take a step back. When you're raising from angel investors, you're going to send them your term sheet. So you're going to get on SeedLegals, create a term sheet, and you're going to know exactly what's in the term sheet because the platform's going to take you through all the deal terms, and you're going to know exactly what you're offering, what they might want, and so on. If it's an SEIS or EIS fund, they're probably going to send you their term sheet, and then you're going to look through the term sheet and you're going to see, I agree with this or not. And when you get a term sheet from an SEIS or EIS fund, they're usually quite founder friendly and will see the terms they're looking for, except for one thing which is distinctly not founder friendly, which is they want you to pay a lot in their fees. And when you get a term sheet from a VC, there are a lot more things to look out for, where the VC wants control in the company, it wants a board seat, it wants investor consent and more. And also it wants you generally to pay their legal fees. So when it comes to SEIS or EIS funds, they do lots of funding rounds a year. Some of them, like Hatch, Startup Funding Club, Fuel, and so on, are already on SeedLegals. And generally, the arrangement will say each party pays their own legal fees, but a VC will have you pay their legal fees, and they'll often put a cap on it, saying you'll pay our legal fees up to a maximum of £20,000 or whatever. So we're going to dive into that, and I'll hold fire on saying what's a good or bad number while we go through the term sheet. So I'm now going to turn on screen sharing, and we're going to see the term sheet from Helpful Ventures. And by the way, if you've got any questions, pop them in the chat. I can't see the chat right now, so Purdy or I may just yell if there's any question that we should go through. So let us dive into the term sheet that you might receive. And of course, even if you are sending out the term sheet on SeedLegals, the investor might be asking you questions. So going through this anyway is good. So the first thing at the top is there's general blah, blah, blah about how wonderful we are. You can generally ignore that. The more blah, blah, blah they put about how wonderful they are, it means that you probably look out for bad terms later on. So they're doing the hard sell at the front, and you can probably ignore that. So the next thing is, this is probably the most important thing, which is how much they're investing and what is the valuation. And sometimes they'll have a go at saying how much equity they want. Generally, your goal, as you might know from SeedLegals articles, is to dilute, median 15% in a funding round. If the number goes much over 20%, by the time you've had your third funding round, the founders can be in the minority as shareholders, which is undesirable. So 250K at a 1.25 pre-money valuation is 1.5 million post-money. So this is 15%, which is spot on the money in terms of dilution. But then the next thing is that this investor is saying that the investment is conditional on you also raising more later. Now, often it's the opposite. It's the investors saying you cannot raise more without our permission because this is an exclusive period. But here they're saying you must raise more. So now This means that your dilution is not going to be 15%. You're raising 500K on a 1.75 pre-money valuation. And I'm not going to do the arithmetic now, but that's over 20%. So have a look for any conditions that the investor has that you can or cannot raise more money as well. All right. So now comes the next thing, which is, and this sample term sheet would be from an SEIS, EIS fund. And here they're saying that like SEI shares with a 1x non-participating liquidation preference. So when you're raising from angel investors, everyone knows that angel investors looking for SEIS have to get ordinary shares and can't get preference shares, otherwise they can't get SEIS. But astute investors know that there is something called a liquidation preference ordinary share, which means that SEIS investors, like funds and VCs, when you sell your company, they can get their money back first. So let's go through this, and I'll turn off screen sharing because the liquidation preference is, can I get, no, I can't make myself full view here. The liquidation preference is one of the most important things to think about. So let's say that you're raising investment on a 10 million valuation, and the investor's investing in getting, let's say, 10% equity. Things don't go well, and you sell your company for 5 million. When I say don't go well, if you've got 50% of the shares and you sell your company for 5 million, that's great. When you get home and tell your spouse or your partner you've sold for 5 million and you've got 2.5, they're going to be delighted. But the investor may not be as delighted because they've just lost half their money. So what astute investors often ask for is a preference share, or if they're an astute SEIS investor, a liquidation preference share, which is an ordinary share that says on a sale of the company, the investors get back, or I get back my money first, and then everyone else shares the rest. And that means if you sell the business at a lower valuation than your last valuation in your fundraise, investors get paid out first. And if it's a non-participating preference, it means that you, as the founders and anyone else who doesn't have preference shares, gets the remaining money. If the investor has a participating preference, it means they get paid first, and then they and you split the remaining. So it's a bit of a double dip for them. So what is okay to agree to and what is not is okay to agree to is super important. So generally, once you've given someone a preference or a liquidation preference share, other investors in the future are going to want it as well. So your goal is to try and avoid giving out preference shares kind of as long as possible. So with angel investors, you probably can give them just regular ordinary shares, but some more astute ones might insist on a liquidation preference. And it's okay, because eventually funds are going to demand their preference share. There's no way around it. The one thing to look out for is people asking for a 2x preference or a participating preference. And these go from it's okay to this is a no-go zone, you're being unreasonable. And, fundraising patterns have been changing with a bit harder, and particularly when investors see that the company has fewer options available and maybe is raising distressed funding, then they may look to take advantage of things. So instead of the investor reasonably saying, on a sale, I want the better of my money back or what I would get if I were, my pro rata share, they might say, I want my money back and my pro rata share. Or they might say, I want twice my money back and a pro rata share. So, you can ping me anytime if you get something that's saying anything more than a 1x preference, because I have a bit of a personal passion that people don't get taken advantage of. So if you've got any questions on that, so I see a question from Tom saying, I've heard that liquidation preference can cause issues for those companies getting regulated by the FCA. I've never heard that before. If you've got any specific example, But all's fair in love and war, and the investor, I don't think there's any problem asking for a liquidation preference and asking for twice their money back. By the way, the worst case that I've seen on that is a company, a UK esports company called FanDuel, sold their business for $500 million, which is awesome. Small problem. They'd given out, or they'd raised $500 million. That's super impressive, with the investors getting preference shares, which meant on a sale of the company, the investors got back the first 500 million, and the founders got back, and the early angel investors got back precisely zero, which is a bit disappointing. So do watch. If you raise a small amount with preference shares, it's not the end of the world. If you raise tens of millions, remember, if you sell your business for a small amount, you personally may not get back much. All right, let me go back to screen share. So the next one in my hypothetical term sheet is option pool. So the investor's saying you're going to create a 15% pre-money option pool. My advice here is that 10% is the norm. It doesn't mean that's the only way to go. Investors, when you create an option pool, it's diluting you, the existing shareholders. So investors might ask you to create a larger option pool, so you don't need to create it in future, but you never know. Maybe you're not going to use the option pool at all. You're just never going to get round to giving out those options before you sell the business. So making a larger option pool is disadvantageous to you. So try to push for a 10% pre-money option pool. If the investor insists on more, it's a negotiation. One reason why the investor or you might want a larger option pool is if you're a solo founder, maybe you want to bring a new founder on board and give them a chunk of equity. And instead of, when you incorporated the company, you had 70% and they had 30, maybe they're coming along later and getting 10 or 15%, even more. And you may not choose options as the best way to do it, but having a larger option pool then may be a good reason for it. All right. So investor director. So when you start your business, you are the board. Sometimes people don't think we don't have a board, but the directors, even when you incorporate, that is the board. But of course, the board's pretty informal. I'm sure you never actually have a board meeting. And if you ever needed to do a board resolution on SeedLegals, you go, "Oi, psst, can you sign on SeedLegals? Great. Yeah, we've had a board meeting. Excellent. We're done." But once you have investment, if the investor wants an investor director, then that gives them, the investor director represents all the investors for certain company governance, and we'll see what that is. And the hope is that they don't ask you to pay them for that privilege, but some of them might ask to be paid. So now let's get to the, wouldn't say dirty secrets because it's a bit unfriendly, but the way that SEIS funds and funds in general make their money. And you'll see this now coming through from the presentation, from the term sheet. So when you have an angel investor, of course, it doesn't cost them anything to make an investment, and they hope that they're going to make their money back plus more. When you have a VC, VCs raise investment from investors themselves, called LPs, limited partners. And these investors put money into the fund. And if you've met with VCs, they've got fancy buildings in Mayfair and with very nice marble offices, and somebody has to pay for that. And that gets paid for by them taking money out of the fund that investors have put money into. And they use that fund to invest in your business. So investors put more money in than they invest. But when it comes to SEIS and EIS funds, they have to take all the money from the investors and give it all to you, because the investors want to get their SEIS or EIS on the full amount. So it's no good if the investor puts 100K into the fund and the fund invests 90K into you, because they can only claim 90K. So the fund has to give all the money that they've raised out as investments. So how are they going to make money? Well, obviously on a sale of the company, maybe they will, but in the meantime, they're going to ask you to pay a range of their fees. And this is where you have to watch very carefully. So if you're raising from an SEIS or EIS fund, and we'll see this in the term sheet, you're going to look through where they're going to be making their fees. And I'm not saying there's anything wrong with it because they have to pay their bills as well. But I look at it as the cost of capital. And your lowest cost of capital is always going to be raising from angel investors. They're going to pay their own legal fees. They're not going to want investor consent rights typically, or board seat rights typically. It's nice and easy. But of course, at some point, you're either going to outgrow the number of angels you can find yourself, or you're just not going to know enough angels and you have to go elsewhere. So VCs are going to want more control in the company. SEIS funds are going to want you to pay a range of fees. And now let's look for where those fees are and go back to the term sheet. And let me see if I've got any other questions. We've got some AI assistants here. And all right. Question from Mark. What happens when all investors have the same share after an exit? How is the value divided up? All right. So it's a good question. The answer is so you sell your company and now you need to know who gets what out of the proceeds of sale. And the answer is you look in the company's articles, and in Article 5, called liquidation, there is sometimes simple and sometimes quite complicated wording that says on a sale of the company, the proceeds of sale will be distributed as follows. And it might say all shareholders will get their share of proceeds proportional to their shareholding. Or it might say the holders of the A preferred shares will get paid back first, and thereafter any remaining assets will be paid to the holders of ordinary shares. So that is the place to look. And of course, that will be built to reflect what you've put in the term sheet. All right, question from David. When's the right time to create an option pool? Good question. The answer is generally sort of about the time you want to give out share options to your employees. But usually what will happen is when you do your first funding round, the investors in the round won't want to be diluted after the round by you creating an option pool. So they'll insist that you create it as part of the funding round, a pre-money option pool. But there's no reason that you can't create it beforehand. It needs a bit of admin, board resolution, shareholder resolution. The good news is it's completely free and takes like 3 minutes on SeedLegals in shares section, increase option pool, and you can create an option pool. So the answer is you're going to do it at the point you want to grant options to people. But if you haven't done it before your first funding round, your investors at that time will probably ask you then. All right, question from Heather. Do you have any advice for a solo founder bringing in a COO or CTO who's unpaid initially? What sort of range of equity would you give? So Heather, this is one of my favorite questions. And the reason is because when you talk to your CTO, it's a bit arbitrary, the number that you're going to come up with. They might be going, I'd like 10%. And you're going, dude, but 1%. So here's the way I look at it is, let's say your CTO would be paid, let's say £70,000 a year for super early stage as a CTO. And let's say you can't afford to pay them anything for 6 months. That's like 35K value. And then you will do a fundraise and then you'll pay them, let's say, half the salary, or let's say you'll pay them 40K for the next, 12 months or something. So let's say that's another 35K. So let's say there's 70K that you need to make up in equity compared to what you could have paid them or they would have earned on the free market. So if your company valuation is £1 million, 70K is 7%. Let's say you're looking ahead and you're going to go, it's £2 million, so that's 3.5%. So you might say, I will give you, 7% or so vesting over 2 years or thereabouts. So if you've got a later joining CTO, typically 5 to 10% might be the go, but it really depends how early. But my recommendation is at least think about it in terms of the equivalent cash that you would have given them and then it becomes a much easier negotiation because everyone understands the money and so on. All right. Question from Darren. We've got a great set of questions here. What happens to any surplus option pool shares if they exist on a sale? So this is a really good question. So let's say you've created a 10% pre-money option pool, and you've gotten to give out a few options to people, and then comes you're fortunate and you're selling the company. So let's say you've got 1,000 shares and 100 options, and let's say they're all unallocated. It's really important to know that when you're talking to the acquirer, you need to agree what they're buying, because it's possible they'll say, we're buying for £10 million the entire shares and the option pool. Great. And now they come to write a check to you and they go, by the way, the option pool is ours and doesn't exist. So that's £1 million. So here's a check for 9 million. And you go, wait, I've just been screwed over here. So when you are selling the company, make sure you agree with the buyer. Are they buying the option pool or are they just buying the shares? And one reason they say they might be buying the option pool, but then keeping the money and not giving it to you, is because if they are, taking over the team are going to work for them afterwards, and they're going to need to incentivize the team and give them their options later. So they might say, we're buying the options, but now that's because we have to give out the shares when people exercise those options later. So it's super important. Now, one thing we've added on SeedLegals is when you do your round, you can tick a box saying the founders can get back unallocated options on a sale of the company. So normally you can't just give options to yourself, but where I recognize exactly the problem that the question you've asked, and that says on a sale of the company, you now have the permissions to give yourself a bunch of options. So because you diluted yourself when you created the option pool, can't you get them back again? And doing a round on SeedLegals, you can. I have to say it's generally not a tax efficient thing to do, because you can't get EMI options because you won't own them for long enough. So you're going to pay income tax on those options, but at least it's better than not getting them at all. All right, so now I'm going to jump back to the screen share, and then we'll dive into a few more questions, and keep those questions coming, by the way. All right, so next thing is the fund here has said that they would like to have an investor director, and they're going to ask you to pay them £5,000 an annum. I kind of don't like the concept of paying the investor director. I think if they want to have a director to represent their interests, and you want them as an investor because you think it'll be useful or you can't avoid it, then great. But, if they're asking to be paid, then this is kind of one of those disguised remuneration. We are getting some money back from you as a fund, and we're going to try and get it back in various ways, which we're going to see as we go through this. All right. So the next one is the board. And of course, nobody cared about the board until OpenAI exploded recently, and now everyone is asking me about board numbers. I think there's going to be a whole event on making sure your investors don't control the board, or that your effective altruists that you've invited on don't want to change the world and you're not part of it anymore. So, of course, the founders ideally should try to control the board for as long as you can. When you start the business, there are 1 or 2 or 3 founders and you are the board. And then you may have an investor director, you may have an NED. You want to set things up so that there are at least as many founders as investors. And also, if there's a deadlock, that the founders have the controlling vote. Of course, sometimes founders don't agree with each other. So in fact, it's probably in early stage companies much more likely that it's your co-founders that are going to have a fight rather than the investors wanting to push you out. But try to be aware that you're in a better position if the founders have got more board seats than the investors. And you also want to try, I think, in constraining, at least initially, the size of your board, because there tends to be board inflation. Every time you have a funding round, the next group of investors want to have an investor director. So you might want to remove one of the earlier investor directors so it doesn't keep growing, because eventually you're going to be outnumbered. And if it gets to any more than 5 people, it's going to be super hard to make decisions. So, early stage, maybe 3 directors, maybe then getting to 4, and by the time you get to Series B, 5, and trying to constrain it to that. Some people think that more is better. Maybe they're right. But I think that anytime, as you know, in a meeting, if there are more than 5 people, it becomes much harder to make decisions. All right. So now comes investor consent. So when you do your early stage angel funding round, my data shows the majority of the time there's no such thing as investor consent. So what is investor consent? Well, certain things need a voting majority to sell the company, issue more shares, do a range of things. And in the early stages of the company, the founders own like 80% plus of the shares. So you can vote to do whatever you want. And since you can vote to do whatever you want, that doesn't really work for investors. So generally, once you get your first fund or VC, and sometimes earlier with pro angel investors, they're going to ask for investor consent. And that means for certain company decisions, regardless of the fact that as founders you own most of the shares, you're still going to need to get their consent. And there it's usually a 50% investor majority. Now, by the way, I should say, some people aren't hugely keen on having lots of angel investors in a round. I love the concept of lots of angel investors, because let's say you only had one VC, they've essentially got a veto right, because they're going to earn more than 50% of the investor shares. So if you have to get their agreement. But if you had 30 small angel investors, any half of them roughly that agree, you're in and you're set. So I like the slightly distributed investor consent, but it's horses for courses. I don't think I'd really change my funding round greatly for that, but I don't think it's a disadvantage. So the question then is, what consents will they want? And over here, you'll see a list, and this is usually a slightly eye-wateringly long list, but broadly, the idea is investor consent is needed for things that you might do that would disadvantage the investors, so, and have them lose money. So selling the company, issuing more shares, pivoting into some other business. You want to be an OnlyFans site. Well, we didn't sign up for that. We want to have a consent right. So you're going to have a look at this list and you're going to see if these all broadly you want to design your business so that the important things that could disadvantage the investors and have them lose their money, reasonably, they've got a say on. But the little things that you need to run your business, you don't want to keep going to investors. So, for example, sometimes there might be over here, incur debt above £25,000. Well, it says outside the normal course of business, so that's okay. Incur capital expenditure of more than £25,000. So this means, for example, if you hire a new office and the deposit is more than £25,000, you may need to get investor consent. I'd find that's kind of uncomfortable, right? Do I have to really ask my investors that I can get a new office space? So I think point to remove a director. So have a think about the things you want to do on a daily basis of the company. Those should be board decisions, and the things that you would do, like selling the company or not, reasonably are investor consents. All right, I won't dive into founder vesting because you all know about that, hopefully. This is not your first rodeo in terms of funding rounds, but noting that investors will often ask for a 4-year vesting and a 1-year cliff. And, it may turn out that your shares started vesting years ago. You've been working with the company, putting your days and nights into the business for the last 2 years, and now, bastard, the investor wants you to start vesting all over again. And worse, with the 1-year cliff. So this means if things don't work out, and you're fired, you leave, something goes wrong, family matter, you leave, whatever it is, you could lose everything. So to me, if I were to do a funding round, an investor would ask for a vesting to start again, particularly with a cliff and particularly with zero shares, I'm just going to say no. So, it's for me, it's a pure walk away. I'm just not interested in doing that. So, if your business started 2 months ago and the investor asked for a 1 year cliff vesting and 4 year vesting, maybe it's okay because founders, things fall apart and actually maybe it's overall a good. But if you have been working on this business for years already, to me, why would I put myself in a position where if something goes wrong, I lose everything? So if the investor insists that vesting starts again after the funding round, as opposed to continue, and you really want to push for that, then you might say, all right, we'll start again, but it's over 3 years and I start off owning 25% and there's no cliff. So, I mean, that's something you're really going to want to push for and remember, it's a double-edged sword vesting because if you leave or you're pushed out of the business or there's a family member who gets sick and you have to take time off and leave the business and help them and so on, you don't want to lose everything. But on the flip side, there are a lot of founder fallouts. And if without vesting, or if too much is already vested, you end up with real problems when a co-founder exits and you can't claw back their shares. All right. I'm not going to zoom to most of these things, and I'm now going to jump into the fees. So remember, this term sheet is from an SEIS EIS fund, and remember that they need to get their fees back from you rather than from the investors. So the first thing is they're asking for an arrangement fee. So 10% is definitely at the high side. You might see a fee of between 2 and 10%. I think 6% is probably okay, which is, we're going to invest 200K in your business and you're going to pay us, 12K for finding that money. Some SEIS funds will ask for 10%. Some of them might be a lot less. It may turn out that these are non-negotiable points for them, and it may turn out once you add all the amounts together, it's just a high cost of capital, and grin and bear it because you couldn't find investment another way, or maybe if you've got options, you look around. So thing one is their arrangement fee. Then the next one might be a management fee. So £2,000 or £3,000 a year, I see fairly commonly. But one of the things to watch out for in the management fee is how long does this go on for? They usually don't put any cap. This means that, 10 years later, maybe they're still charging a management fee. Of course, in 10 years' time, you may have raised 20 million or more, and the £3,000 a year is like the 20th of your HubSpot fee, so you don't care. But um, money is money and it adds up. So perhaps try to see, can you cap this to 2 years or something so it's not ongoing? All right, now exclusivity. When you sign a term sheet, you're saying typically that you won't solicit investment from others other than described in the term sheet without the approval of the investor. So be aware that long exclusivity periods can be problematic. So the investor is going to say, we want 60 days, let's say here, exclusivity while we do due diligence. But your fundraising is pretty much on hold. So you can't go off and talk to other people in the meantime. And it's really giving the investor an advantage because they can mess around for as long as they want. If they know that you are out of other choices and you're running out of money, you're not going to be in a position to negotiate much. So try to aim for much shorter exclusivity periods. 30 days would be ideal, 45 okay, and 60 is definitely, I mean, that's a lot of weeks that you can't go talking to anyone else. Also, look at the exclusivity period and see what they've got exclusive. So I've seen one SEIS fund It says we have exclusivity on the SEIS investment for 45 days. Knock yourself out. You can talk to EIS or other investors. Just don't talk to anyone else to compete on our SEIS. I think that's quite good. You can just talk to anyone you want. You can promise them EIS, but not SEIS. But if you can't talk to anyone, remember your fundraising is pretty much on hold while you're talking to this investor until they deign to get back to you. All right. Now, the other cost that you might have is keyman insurance and director and officers insurance. So keyman insurance is when, you're insuring yourself, which is all very nice. It's a great ego trip, but, is it really worth spending several £1,000s on insuring yourself? Yeah, I'm not sure. Uh, if the investor is asking for a director position, they normally want the company to get out direct and officer insurance. So if they sued, the insurer will pay, and that's not unreasonable. But remember, by committing to these, the key man insurance could be a few £1,000s a year, depending how much insurance you want. And the director and officers insurance could be, I'm guessing I forget, for us, a few £1,000s a year. And if you're raising 150K, all of these fees are going to add up. You want to spend it on IOSTA or web developers, not insurance. All right. Then the next thing is the legal fees of the investor. And as I said, with SEIS, EIS funds, because they do many investments, they usually do their legals in-house, or it's all on SeedLegals. They often don't ask you to pay their fees, which is great, but VCs will usually ask to pay their fees. And the special call out for me goes to Octopus Ventures, who I saw in a term sheet want a cap of £100,000 on legal fees. It's insane. So that covers the legals and due diligence. But the two problems with a very high cap on legal fees for the investor is, number one, of course, you can hire an IS or other developer for more than a year for that amount. You definitely want to be doing a development, not paying their lawyers. And number two, the more that they pay their lawyers or you pay their lawyers, the more their lawyers are just going to make work for themselves, trying to change every word and do more due diligence. So you want to really work hard on getting the cap down to, £20,000 as an upper limit. If you're raising a smaller amount, a few hundred K, 5K to 10K would be the norm. And if it's much over 20K, give me a call and we'll do a sanity check on it. All right. So that was quite a rollicking thing. I hope it was interesting, because term sheets could be like super boring, but I see a bit of nodding there, a bit of smiling. Okay. So let me go through the questions. So question from Engine, your take on reverse vesting.
Which
So I
you've
know that
already answered.
Engine,
Which you've already answered.
all right, good. And I know that Engine's the investor, so he's probably asking from the investor side. All right. Okay. So
By the way, well, I'm an investor and a founder. I think it's a horrible idea. I'm totally against it. It's against everything I stand for.
the reverse vesting?
Absolutely. I am completely an unfan.
Right. Okay. Interesting. All right. Cool. Vesting cuts different ways. But next question from Rob. Would you not have to offer more than cash equivalent sweat equity? All right. So Rob's question goes back to, you're about to hire a CTO, and you can't pay them their salary, so you're going to give them some equity instead. And Rob, yeah, you exactly right, which is you now picking a cash equivalent is a good starting point for negotiation. So you're going to say, well, my company valuation's 2 million. And so, 70K is 3.5%, but we'll do it over 2 years. So it'll be 7%. And they'll go, but when you do your funding round, I'll get diluted. And you'll say, yes, but when I do my funding round, the valuation will go up. But it's a negotiation, but it's much easier with that as a starting point than to go 4%, no, 10%, no, 0.1%. It grounds the numbers in my view. All right. Question from Mark. How common is it for founders' loans to be repaid back when you raise funding? So this is a great question. I see a few people emojid it. So my data on SeedLegals says that founders put a median £26,000 of their own money into the business at the beginning, because no one invests on a PowerPoint. You need to have built a prototype and done research and so on. So is this just sunk money, or can you ever get it back? And the answer is you can call it a founder loan and get it back someday. And now the question is when and how. So, what's not going to happen is you raise 150K and then immediately pay yourself £25,000 back from that, because investors want their money to be used to grow the business, not to pay you back. And also you can't use EIS funds to pay yourself, or the investors will lose their EIS. So be careful of that. So, to repay a loan, you can pay yourself a salary, but not a loan. So what you can do is the default on SeedLegals is you can tick so to say your loan will be repaid from the company's free cash flow. So when you start becoming profitable, you can now start paying your founder loan. Or you might decide that you're going to convert it into equity. So when we started SeedLegals, my co-founder and myself each put quite a lot of our own money into the business. But then when we did our first funding round, we converted that as if we were investors in the first round, so we didn't get diluted as much and got equity. But broadly, the time that you can repay it, agreed with your investors, will be either when the company becomes profitable, or potentially on a sale of the business later, or broadly when the investor consent is received. So the idea is you will get it back, but not at the point that a good fraction of the funds are going into repaying it. And by the way, if your founder loan's like 20K or 10K, no one's going to care. If your founder loan is £400,000, there's going to be a lot of scrutiny, and you're definitely going to need paperwork to show how you put that money in and so on. It's not £400,000 that often, but I definitely do see it. All right. Question from Mark: should we all start an SEIS fund? That's a good point, actually. It sounds appealing, but there's something else you can do. Since we've just launched syndicates on SeedLegals, maybe you can launch a syndicate, and then that becomes even easier. All right. Question from Tom: how can they ask for exclusivity when they expect you to raise a further 250K? So yes, Tom, in my hypothetical term sheet, I mixed and matched different things. So, what would happen if they really were saying you have to raise 250K? Then the exclusivity would be, saying in addition to our 250K or something like that, to carve it out. But yes, the two together, as you spotted, the eagle eyes, would not work together. All right. Question from Rajesh: is it a good or common market practice to pay some equity for part-time freelancers who want sub-market rates? Yeah, I think so. That's why you've got equity to use. So you've either got cash one day, when the business is profitable, you've got cash. And in the beginning, you've got equity. So, of course, people can't pay their mortgages with equity. So people really need money to live on. So it's unlikely that you'll be able to get people on a long-term basis with equity. And also equity becomes inefficient, because if your valuation is low and you start paying people with equity, you're going to be giving out a lot of equity. But as a sweetener later on, and as a substitute for cash earlier on, there's certainly nothing wrong with using equity. So that was the things I wanted to cover. Purdy, MA,
Yeah.
questions?
There was one more question that came in on the chat at the beginning about advisor equity and whether that comes from the same option pool. So do you have any advice on that?
Yeah, so good question. So here's the 101 on share options and option schemes. So there's an option pool is just a reservation saying we have factored in dilution. So by creating an option pool, when investors come in afterwards, we've already factored in that we can give out shares from this option pool without further diluting the investors, because we factored that in already. But what type of options? Are they EMI options? Are they for advisors? Are they unapproved? The option pool is a pool that covers all of it. So you never have more than one option pool. It's just one pool, and you dip into the pool, and the people getting shares will now get them according to different option schemes, depending on whether they are an employee, when you'll always use an EMI option scheme, which gives tax benefits to the employee and tax benefits to the company. And if they're not an employee, then it will typically be an unapproved option scheme, which doesn't mean it's illegal. It means you haven't agreed the valuation with HMRC, so it's not tax advantaged. So yes, advisors, consultants, you'll give them options with an unapproved scheme, and employees with an EMI scheme, all from the same share option pool. All right, question I see from Mark. Thoughts on compensation for a customer advisory board? Tell me, Mark, what do you mean by customer advisory board?
So I've started two of these before, one being in my current business now, and there's actually no compensation for them. They're basically just early adopters that are helping us to build the product. But I read an article recently, I think from the chap who started Sterling Road, and he spoke about how he thought every business should have one, get those early adopters on board and build them with the product in mind. And he spoke about a very, very small equity percentage, right? And I've found in the past, it can be challenging if you have people on your CAB and you're not paying them anything, or there's no incentive. Ultimately, when push comes to shove, they disappear. So I'm wondering if there are any thoughts in terms of, if you had no cash, how you could kind of keep them incentivized.
Great question. My take is that, of course, you always want to get customer feedback, right? So do you need to pay for it? So the first thing is, if you can get customers to give you feedback because they love you, they want to be helpful, you're better off doing that than, needing to pay them. It may turn out that as soon as you start paying them, it starts changing the relationship, maybe for the better or maybe for the worse. Maybe you wanted you just needed a small amount of feedback from a customer, and then you don't want to talk to that customer again because they now know your product, and you want to talk to somebody else who's a new person to your product, so you've got a different product. So creating a board of ongoing feedback is certainly a possibility, but it's not the only one. So now when it comes to giving them share options, which could be nice, your challenge is, if you go, I'd like to give you share options, and you're going to get 0.01% equity, it doesn't sound that exciting. So here you might want to think about the equity and talk about it as a cash number. I'm going to give you £1,000 of share options, which sounds, potentially quite nice, or £100 or whatever it might be, as opposed to 0.01%. It's like, I'm not sure that's hugely exciting. It may still work out at the same number, but maybe think about it as a sort of pound equivalent. I'm going to give you £1,000 for being on my customer advisory board for the next year, £1,000 of share options, and if you're okay, then I'll create an advisor agreement promising you that kind of thing. All right, I hope that answered. Question from Marco. What if a company has an extant loan when starting an EIS raise? You mentioned a founder loan can't be repaid. This is a very good question, Mark, which is sorry. You can't repay loans with EIS money. Strangely, it's slightly different with SEIS money, but the whole point of SEIS and EIS investment is to grow the business, and HMRC doesn't consider repaying loans the use of that money. So yeah, you can't use EIS funds for any loan repayment, or you may disqualify the EIS. You can use it for business debts, of course. So, you buy an Apple, a Mac, and you have to pay Apple, that's fine. But directors and other loans can't be repaid. And that's also something to think about if you think of raising investment with a convertible note. A convertible note, when it gets to maturity, sometimes you can set it up so that it converts into equity. But in other cases, the money has to be repaid. So if you've raised from the future fund, and you haven't done a funding round before the maturity date of 3 years, the loan has to be repaid, and you can't use EIS funds for that. So it's definitely something to look out for. One of the challenges is if your company is cash generating, even if overall you're making a loss, you might create 2 bank accounts and put the EIS investment in one and your trading money in another, and then use the trading money to repay loans while the EIS money gets used to pay salaries. So you can set things up carefully to avoid it being contaminated, even though, as we all know, money is fungible. All right. Question from Krish. Is it a good idea to start a subsidiary if an international, if they're foreign investors? And the answer, Krish, is that investors always invest in the top co. There's never any value in the subsidiary because the top co controls the subsidiary. And on a sale of the company, the top co might decide to pay nothing to the subsidiary. So no rational investor will ever invest in a subsidiary unless it's something like a franchise where it's loosely held by a top co. So you're always going to get investors in your top company. And I mean, I reckon at least 20% of the rounds on SeedLegals have got foreign investors, and it really makes no difference. You probably want to check they're not a sanctioned individual, but otherwise it makes no difference to you where the investor is. By the way, one thing it might make a difference is banks are an absolute pain when it comes to KYC checks. And, I want to do some partnership with Tide, as part of which they needed us to create a bank account. So I went to create a Tide bank account. So going, this is like super easy on their app. This is awesome. And then got a message back later saying, we see that you've got Index Ventures as an investor. They invest via a fund registered in Jersey. And I'm sorry, you can't have a Tide account. It's like, okay, that's a bit mental. So be aware that if you've got foreign investors or shareholders with more than maybe 10% shareholding, it may be problematic with some banks to get an account. I don't think that's a reason to not have a foreign investor, but it's something to know about.
Anthony,
all right.
It gets even more interesting when you're not a UK resident yourself. It took Tide about 5 minutes to turn me down for a bank account. So I'm going to take it to them at some point and say, remember this? When you turn me down, enjoy it now.
Exactly. The retribution comes back later. Okay. All right. So question from Onda, which is, can we talk about crowdfunding? The answer is yes. On tomorrow, when I'm doing a webinar with Chris Eastwood from Penfold, who has raised, I think, £17 million in a mix of crowd, angel, and VC. And we're doing a webinar tomorrow on mixing crowd, VC, and angel investment. And he's going to share his tips. So this is my plug for that event. And if you drop me a note, I will pop the details, or if I get a chance, I'll pop the details in the chat over here for tomorrow. Question from Tom. At what stage are you typically seeing founders cashing out their equity as part of a funding raise, if at all? Very good question. So as founders, maybe you could be earning 150K working at some big company, but you're not. You're earning like 40 or 50K working for a startup. You've got lots of equity, but it's not helping with your mortgage. So should you wait and keep your shares until the sale of the business, or should you sell some of your shares en route, which is often called a secondary share transaction? So maybe your next funding round's at a 20 million valuation. And if you sold some shares, maybe you'll get £1 million. The good news is that in the UK, there's entrepreneur relief, now called business something relief. And the first, you can sell £1 million of shares paying just 10% capital gains tax. It used to be 10 million, now it's just £1 million. But getting £1 million at just 10% CGT is pretty good. So the answer is absolutely. I think too few founders think about that. A couple of startups ago, I sold £1 million of shares, which and paid 10% CGT, which fueled my startup habit for a while, and mortgage. So that was definitely something to look at doing. Of course, the problem is you end up with less equity, but businesses sometimes work and sometimes don't. And if you're waiting for payoff and gold dust at the end, that's definitely adding a lot more risk. And it may turn out the most efficient way of you making some money, for that mortgage, whatever it might be, is, selling some shares, perhaps more than £1 million, paying a small amount of capital gains tax, as opposed to 40-something%, income tax. So definitely something to think about. And then you want to make sure that you've got the legal rights to do this. So when you do your funding round on SeedLegals, one of the other nice things is there's a box to your selection to say allow the founders can sell up to, and we put a default of 10% of their equity at any time without needing further consents, because otherwise it's quite a difficult task. You need the co-sale rights and preemption rights and investor consent rights to sell your shares, and these, you and the investors are agreeing that you can sell up to % of yours without such rights. And the reason that exists on SeedLegals is exactly because I did this a few funding rounds ago, when it was not very well known, and I thought it was a very good thing to do. So it's now a one-click option for everyone else. All right, I would love to talk longer. I've got to run, and I think we've hit the magic hour. Purdy, MA,
Yes.
over to you.
We actually had a few more things that we wanted to cover with you, specifically something about valuations and whether you've seen any difference in valuations at Seed for 2023. So if you can answer that in 30 seconds or less, that would be amazing. If not, we can just have a chat and send that around to everybody afterwards.
I haven't been tracking, and I probably should reach out to our data team to get that info. I think what's reasonably well known is that, once you are making revenue, investors will often value the company on a multiple of your annual revenue. And it used to be in the olden days, maybe 6 to 10x annual revenue for a sort of SaaS company would be your valuation. So doing £1 million a year in revenue, maybe 8 to 10 million pounds valuation. And then in 2021, 2022, those numbers went up to 10 to 15 times multiple. And now they're back down to maybe 6 to 8 times multiple. So, once you are revenue generating, then investors will often put a multiple on that. And that might be at sort of Series A and beyond level. Before that, how do you value a company? Is it based on your pitch deck? Is it the segment? I'm not sure that at seed or angel round stage there's been that much of a change, because really, to me, the dynamics then are you're selling 15% equity in your business, you're raising 200K, therefore the pre-money valuation is 1.2 million or 1 million or whatever it might be. And that sort of formula is preserved. But I do need to go and run the numbers, and maybe there's an action for me to run the numbers and get back to you on that.
Thank you so much. And we're actually co-hosting an event with SeedLegals in a few weeks' time for people that are preparing a 2024 fundraise, where we're going to be talking about the increase in the SEIS limit to 250K and the implication that has had on other founders in terms of how much they're raising and what their valuations are and that kind of thing. So if anybody wants to come along to that, we'll put that in the chat as well. Anthony, we will let you go. Thank you so much for that.
Thank you all.
Thanks, Anthony.
I hope what was as interesting as the presentation was one could get on term sheets. And if you want to join as well tomorrow, that should be quite an interesting session. Thanks, everyone.
Thanks.
Okay, founders.